Let's start with the challenges, shall we? A raft of regulation. Banks are currently wrestling with the new margin rules, and after that they'll be looking at MiFID II, which is going to be implemented in January, which is months away. Then you've got FRTB. Certainly on the structured product side, there's all the documentation that has to be worried about as well, with PRIPS and KIDs and term sheets if it's for corporates in OTC derivatives. All of that whilst reducing costs and trying to increase flow. Banks are changing. There's no more prop desk because of the Volcker rule. So traditional banking is back in focus, servicing customers, high net worths, corporates by market making. Therefore, the trend is automation through fintech, which has actually been now split into two. You've got Reg-Tech and fintech. So from solutions for FRTB to wealth management, e-commerce, e-platforms for investing, the electronification of the remaining processes in the dealing room, and parsing multiple venues into one blotter. Many markets were believed to be unelectronifiable, if that's a word, due to their complexity, exotic options, structured products. If I needed to price a multi-leg FX option, a strip, for example, it would take some time, even longer if solving for certain outcomes. But new technology, faster processing of models and methodologies has changed the landscape. Customers can have a real-time price, deal on it, download supporting documentation from the market maker with minimal human interaction. The regulator is forcing the change, requiring audit trails and documentation with proof of suitability. Previous, it was cost in equities and futures, easy to go on screen, relatively, standardised contract specifications, and then you get a reduced headcount, reduced costs, so faster execution and more business. Trades also need to be processed as quickly as possible to calculate real-time risk, VAR, and even before quoting, certain suitability tests need to be met. Has the customer got the funds, the margin, the credit, and all the XVR calculations priced in as well? Add in real-time risk, and in effect, many traditional complex markets are now becoming a flow business, especially in FX, interest rates, and equities. I'd say banks have been doing it for many years in other asset classes, certainly in the more vanilla products. So they've already gone through this experience even in the 80s, 90s and 2000s in equities, in financial futures, in foreign exchange, spot foreign exchange and forward foreign exchange. It's now looking at the opportunities to do that in OTC derivatives and structured products. And as far as how it's changed the banks, there was a recent statement by Daniel Pinto from JP Morgan, who sees a quarter of all market revenues now coming from electronic trading, $5.5 billion worth in revenue, in fact, and stating that in interest rates, 90% of his business is now done electronic, so nearly all of it. And you've even got, the retail guys, the big retail guys like Saxo Bank and CMC have been offering fantastic cross-asset electronic execution to people like you and I for quite a long time as well. So people are used to it. They expect to see it, and let's face it, our whole lives are now electronified when it comes to checking in on a flight, or sending a birthday card or a Mother's Day card, or even buying your groceries online, auto checkout. Well, they're even talking about driverless cabs. So we're no stranger to automating processes.